Does this look like an issue where economists got it wrong, or maybe the government got it wrong?
Well, if you take it in combination with jobless claims that were better than expected, and combined with the last 3 months, we've seen non-farm payrolls at 276,000. The labor market is still very strong, so the economy continues to do well, and this is not least because of the Fed beginning to talk about rate cuts rather than rate hikes, as they did, of course, before November of last year. That change in tone unleashed a rally in the stock market, where now the S&P is up almost 10 trillion since November the 1st. And that increase in the stock market, for comparison, consumer spending in 2023 was 19 trillion, but that basically meant that we had a huge wealth gain, and that's what continues to fuel the economy.
But the Fed is looking less and less likely to cut rates anytime very soon. June, if you look at the Fed fund futures, no. July, not so much. And Steve was pointing out yesterday that September was even coming.
That's why I don't think they will cut rates this year. If you do scenarios and expectations for what inflation will do over the remaining 8-9 months of this year, you still can get a scenario where inflation can be in the 2, 3, 4 range. So in other words, the tailwind that we have from easy financial conditions, what is done to increase in the stock market, to home prices, at the same time, cash flows in fixed incomes are very high. So it's not a surprise that consumption, maybe not in the GDP report here was a bit special, but generally speaking, retail sales has been strong. That all argues for more non-farm payroll strength, more inflation strength, and that's why inflation is picking up.
You know, I think there's an asymmetric approach to what's going on based on investors, and that asymmetric approach is here we get definitely hot inflation numbers, cooling growth, and jobless claims remain low. That to me, a healthy labor market's probably just lasting because of how much money the government has spent, how much money the government continues to spend. But in the grand scheme of things, keep it simple. These numbers aren't really good, and if you're looking to Fed fund futures to tell you the future, you're looking at the wrong contract. I think Torsten has a better potential track record on calling what the Fed's going to do than looking at distant futures contracts for Fed funds, which are just fancy T-bill contracts. They give you a good indication of the next meeting. To draw any more significant conclusions beyond that, you're really beyond the limits of what the contract can or cannot do. Ultimately, what the Fed needs to pay closest attention to is the idea that there's so much potential problems down the road with so many large industries, so many question marks on things like energy, natural gas, how all of those things in some of the special things that you need to put the batteries together, some of those minerals, all of these issues are coming home to roost at a time where the U.S. economy is being held back in areas that it's good at, like energy, and it's being force-fed in other areas, like transitions into new standards of driving and vehicles that the public isn't ready for. These numbers are telling us that the future is probably less growth and higher prices and higher deficits for a long time.